When you're playing chess and your opponent creates one weakness, you can defend it. No problem. You have the resources, you can go defend that weakness. When they create a second weakness, you can't defend both. And that is what leads to checkmate. One of the things we've talked about for the business cycle is that the Fed can defend one weakness. If inflation is running hot, then they raise rates. If the unemployment rate is running hot, they lower rates. What do you do when they both go up? That is what leads to checkmate. Now, in this case, we have some data, which is exactly what we've been discussing as this potential outcome, and it's what inevitably leads into the end of the business cycle, right? Like, it's the beginning of the end. It can still take place over a long period of time, right? Like, it can still take place over a year or two. It doesn't have to all play out today. There's some scenarios where you could see new highs in some select stocks, right? Like, it's not impossible. But the point is the Fed cannot defend both weaknesses. And that's what usually leads to the end of the business cycle. So, the first thing to note today is that we got non-farm payrolls in, and they came in negative 92,000. Now, do you see all the gray shaded regions on the chart? Those gray shaded regions are, in fact, recessions. Now, we have not had one yet. I mean, we really haven't had one since the pandemic, and that was barely a recession. Unemployment rate was going up, and it just fell off a cliff one day. Black swan event, right? Like, you can't really predict that. It's not a very predictable outcome. In this case, the unemployment rate has been slowly plateauing for a very long period of time. But the way to look at this chart is not to look at it through this lens. It's to look at it through the year-over-year change. And when you look at it through the year-over-year change, you can see that the gray shaded regions are when the year-over-year change in the unemployment rate goes below zero. Meaning when you go a full year with net losses in jobs, that's when your recession occurs. And you can see right now, a year ago, we've only added about 156,000 jobs. 156,000. Now, in pre-pandemic times, we were adding 1 to 2 million jobs over the last year, like as the years went on, about 1 to 2 million. But you can see that this is dangerously close to going below zero. Now, if this were the only problem, then the Fed could just simply go aggressively cut rates, right? That's all they would have to do. And there likely will be some more rate cuts, right? There likely will be. If you look at the CME Group expectation for rate cuts, despite the fact that the unemployment rate came in higher, and despite the fact that the price of or despite the fact that the non-farm payroll came in below zero, the Fed isn't looking like they're going to cut necessarily. But why? Why not? Unemployment rate's at 4.4, and we haven't really created barely any jobs over the last year. Wouldn't it be appropriate to cut rates? You would think so. But the problem for the Fed is that this is not their only weakness that they're trying to defend. They're also trying to defend price stability. And the issue that we have is that on the same day we had this negative payroll print, oil is up 12 to 13%. So that's the why. That's the reason why the Fed can't aggressively cut rates, because energy prices, not just oil, but energy prices collectively, I think make up about 7% of CPI. That might not sound like a lot, but when energy prices can swing, say 30 to 50% in a year, they can have an effect on inflation. And so oil prices are not responsible for how the business cycle has played out so far. But what oil prices can do is they usually rally before the recession occurs. Look at 1990, look at 2000, look at 2008, and then look at 1980. So that's why I've been saying for so long that it was premature to call for a recession when the price of oil was going down. Because usually it's the price of oil rallying in a late business cycle environment that then leads to the beginning of the end of the business cycle. Now, what is this business cycle that we're talking about? And are business cycles the same thing as 4-year cycles in Bitcoin? And the answer is no. They are actually two very different things. You can have multiple Bitcoin market cycles within the confines of a much larger business cycle. So they are two very, very different things. You might have people out there that will say that not all business cycles end in recessions, and perhaps they will reference several years throughout history where you did not have a recession, like 2022, like 2014. The problem is that they're not looking at business cycles. They're looking at smaller market cycles within the confines of a larger business cycle. And one of the ways that you can visualize that is we have a chart here on the ITC website, and it's called the ITC Business Cycles chart. And this chart was created by taking the S&P 500. We don't have to put the S&P 500 in there, but I put it in there because a lot of times I think it makes sense for people to understand things through the lens of something they're probably invested in. So we have the S&P 500 divided by the unemployment rate squared times interest rates in the United States and times the inflation rate year over year. We then divide all of that by the money supply. And when you do that, you get a chart that looks like this. So can we say that there was, that not all business cycles end in recessions because there wasn't a recession in 2014 or 2015? No, look at the chart. Like, the things were not elevated back then. Markets were going up, but we were not in a bubble at all, right? I mean, this was at zero, basically. So you can't say that, right? Can you say that we didn't have a recession in 2022, therefore not all business cycles into recessions? No, because we were in the bubble then. Like, we've been in that bubble. It takes a long time to play out. And what you'll notice on this chart is that every single business cycle of the past, every single one, it was the recession, that then led to this metric going back to basically to zero and to starting a new business cycle. It was a recession at the end. And so some people have asked, well, like, what is this representative of? How has this been going down and the market's been going up? That happens sometimes, right? Like, we've seen plenty of times where it'll go down and the markets go up. It's not as frequent, but it does happen. Like, look at 1989. It was going down, and then we got the recession, and then the market had a 20% drop. Now, not all recessions are 50% drops. Some are 20% drops. Some are 30% drops. They're not all the same. So one of the things that you have to consider here is that up until this point, the Federal Reserve has been able to achieve a soft landing. This, so far, was what a soft landing was looking like, where they were basically just slowly bringing this thing down. They were raising rates, they were bringing inflation down, They were trying to unwind things. But the plane still hasn't landed. The plane was at 35,000 feet. Now you could argue the plane's at 5 or 10,000 feet. Like, we're still not out on the ground yet. The problem is that there's a lot of uncertainty right now in markets, and markets hate uncertainty. They hate it. And when you think about geopolitical conflicts, when you think about, the rise in the unemployment rate, you think about the price of oil going higher, and etc., there's reason to talk about this stuff. Now, I know there's a group of individuals that, sort of say that anyone who talks about this stuff is just too pessimistic. But the thing is like they were also telling you that Bitcoin was cheap at 120K. So bears sound smart. Bulls make money over the long period of time. That is true. That is 100% true. I do not disagree with that. I buy index funds every single month, regardless of my opinion on the markets. I always buy them. Sometimes I'll buy different ones. Like if I'm more bullish on another sector or another, a specific region, I might buy those index funds rather than other ones. But I'm always buying something every single month. But that doesn't mean you don't eventually have bad times, right? It doesn't mean that you can avoid those things forever. Now, with the S&P, I mean, I've mentioned for a while, and we're going to talk about Bitcoin too. I've mentioned for a while with the S&P 500 and with Bitcoin that with the S&P, like it was starting to show this weakness that Bitcoin showed, where it looked like it was sort of stalling out up here and like it was likely going to get a correction. Now, I don't yet know if this is the larger correction or not. It could be, but there's not a guarantee. I mean, one of the things if you look at like the S&P 500 divided by M2 and you look at the business cycle that we've been in for a while and you compare it to what happened, back in the 90s, and you look at sort of this move from 96, what you'll notice is that it lines up almost perfectly. You see these like corrections in here. You have this correction that lines up. You have this 20% correction that lines up. It's possible that we're here, right? Where we're like in this correction, but then we like bounce out of it into April and even into 2027. And then it could start to go down. I don't know if this is how it's going to play out, but this is something to consider. And the reason why I say this is because, look, topping is a process for the S&P 500, right? Like it takes a long time. And so there's a chance the S&P drops, from the current levels or from the highs, 10, 15%, and it still not lead to the negative feedback loop that we've talked about. We're not necessarily in that negative feedback loop yet. And that negative feedback loop is characterized by layoffs increasing, which then lead to less demand in the overall economy, which then lead to more layoffs. But right now, layoffs are still relatively low. They're still really low. I mean, they're basically at the pre-pandemic levels. So the reason why the unemployment rate has not yet entered its non-linear phase, right? Like the reason it hasn't yet entered its non-linear phase is because layoffs are low. We know that all the other metrics don't look great, right? I mean, if you look at hires, we got that data a while back. You can see that hires are really low. If you look at quits, you can see that quits are really low. If you look at job openings, they're really low too, right? They're like falling off a cliff. So when you go, we have this workbench where you can sort of bring in different indicators and create your own. Let's do that. Let's take in job openings. We're going to add that. This is a metric that Powell frequently references. And we want to look at the unemployment level. So we're going to add that. Now, if you take the number of job openings per unemployed worker, M1 divided by M2, you get this. Now, what do you notice about this? It's below 1, right? So there's now there's fewer job openings per available worker than there was while this was getting unwound. So the excess that was there, that has given people so much confidence that it can go on forever, that excess is no longer there. So basically, it's led to them being really bullish on risk assets because this getting rid of this excess gave them a false sense of security. Now that we don't have that excess anymore, as the labor market weakens further, the market really starts to care. And it's always possible the S&P goes higher. The problem is that this is starting to really look like a topping process over a long period of time, right? Think about Bitcoin, right? I mean, think about how long that one spent at the highs before going back down. It had a high here, and it only went marginally higher later, and then it fell off a cliff. You see that? So I think that, and one of the things that I've mentioned with Bitcoin was to expect a sort of a rally into early March, and that it would likely get sold off. What's interesting is that this high here was on March 4th. So if you create the table, 2014, 2018, 2022, and 2026, when you start with 2026, you have March 4th. We don't know for sure if that is going to hold as the top. In 2022, it was a little different than the other years in the sense that we had the local high on March 2nd, but then we swept the high on March 28th at the end of the month. So if we add that on here, we say March 2nd swept high on March 28th. But basically, the highs were mostly in by the 2nd of March. And then if you go to 2018, the local high was March 5th. And in 2014, if you go all the way back to 2014, the local high was March 3rd. So you guys notice a pattern there? So in 2014, March 3rd, 2018, March 5th. So you have March 3rd, 5th, 2nd, and maybe 4th. This rally by Bitcoin was the one that I was talking about the last few weeks, because we usually have a rally in March, in early March. And when you look at the year-to-date ROI of Bitcoin in midterm years, right? When you look at it in midterm years, look at it. It had the rally at the exact same time that it always does. And it got sold off at the exact same time that it always does. And despite all of this, every troll known to man was coming after me on Twitter on March 4th. What do you do? What do you do with that? So I think that in the context of the business cycle, the Fed has two issues. They have a rising energy prices, and they have a weakening labor market. And I don't think they will be able to address both issues in a timely fashion. And that's what leads to the uncertainty, which then leads to these drops in markets. And we've been talking about the S&P for a while, how this looks like a distribution phase. Even if we bounce back up to a slightly higher high, like it's still a distribution phase, I think. So if you think about Bitcoin, Bitcoin sort of shows you the way in terms of like where markets might eventually go. And, Bitcoin already sort of broached these levels. You could argue that Bitcoin is further up the risk curve than the stock market. Look at the stock market, right? Like it's probably going to eventually go back down there at some point. And if it gets really bad, it could come all the way back down here. So we'll see how this plays out. But those are my thoughts. And I've said before, the Fed can defend one weakness, but they cannot defend two. And if they have both to deal with, that's what leads to checkmate. Right now, I think the Fed's in check. So they're gonna do some stuff, right? They're gonna try to talk their way out. I mean, I'm sure there's going to be some volatility here in the coming months, but that doesn't mean the Fed is not under check. So those are my thoughts. I hope I've been able to communicate these business cycles with you guys as clear as I can. It's difficult with all the noise out there, but I just want people to understand like how these things work and how they take place over very, very, very long periods of time. So to the Fed, check. It's your move. Thank you guys for tuning in. Subscribe. Give the video a thumbs up. We also have ITC Premium at intothecryptoverse.com or benjamincowen.com as well. Thank you guys for tuning in, and I'll see you next time. Bye.